All right. Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the Last Week in Mortgage Today, our weekly walk through all the latest news in the mortgage industry. Also, taking a look inside the current business climate and along those lines each week. Pleased to have one of our lender members join me as the co-host each week. And this week, really thrilled to have back in the co-host seat the CEO and president of First Mortgage Direct and Bison State Bank, Ryan Weibe. Ryan, good to see you, brother.
My man.
And Ryan, I love getting your perspective. One, because you're really smart and a great guy, but so many IMB CEOs I've heard over the year, like, oh, I should buy a bank, or I'm going to go buy a bank. You actually went out and bought a bank, Bison State Bank, a couple of years ago. Just start there with I know you got some exciting news coming up soon here along those lines, and tell us a little bit about it.
Yeah, I know. You go back to 2018. So we bought one of the smaller banks in the state of Kansas, and we're working on growing it. And the theory behind why IMBs want to buy banks is various reasons. But one is, if you can't beat them, join them. If you can't join them, you buy them, right? We get the licensing barrier is knocked down. You get to go into all 50 states. Cost of funds go down, warehouse lines get expensive. Sometimes you got the haircuts. And so there's a lot of these economies of scale that you get inside the bank. But what you get in return is sometimes a little hindsight 2020. Your regulatory environment is significantly different than it is as an IMB. It's your compliance teams and your compliance issues are significantly more. Those are the challenges that you go through, but it's been a really good transition. It gives new life. There's new products that you can put in, some portfolio products, and different tools that our loan officers could really use when they're on the streets in competing. For instance, one of the neat things that we're getting ready to potentially roll out is similar to a cash offer, right? So all of our buyers and our pre-approvals, they're all shopping. They're making 6, 7, 8 offers, and it still continues even in this high interest rate environment. Well, one of the ideas that we've come up with, and maybe we're ripping it from others because you hear these things out there, is an offer in which the bank we will purchase in cash on behalf of our buyer, as long as it's not an FHA loan. And if they're a VA or a conventional, we'll do it. But the bank is looking at buying the properties, so it's a cash offer, and then in turn, completing the purchase transaction with our borrower. So some of those things that you can have at the bank level. In fact, you could probably do that at the IMB level too. But it's nice to have a different set of tools in the toolkit, right? Construction loans, or talking to a self-employed borrower who owns their own building, and being able to help them on the their commercial side of things, as well as their own primary residence or their second homes. So it's been really fun. It's been interesting.
That's awesome. And some of the background noise, I'm at the Texas Mortgage Bankers Association conference in Austin, and there's been a lot of talk in the hallway about, and companies here along that line, like trying to turn prospective buyers into cash buyers. There's some third-party vendors that are trying to do it now. Our conference in Miami a month ago, there was a lot of talk amongst the banks and the IMBs using some of their cash to do that. So because everybody, right, is sitting on right now just huge pipelines of pre-approved buyers that can't find a home.
That's right. I mean, we're not isolated to it here in Kansas City. It's all across the country. There's just such a limited supply, and sellers are really dictating the entire process. And I mean, I'm getting stories, and I hate to drive the bus over myself and my own organization. We lost out on a deal last week because a commitment letter was sent 45 minutes too late. Too late. It missed the cutoff date by 45 minutes, and the seller or the buyer lost the home because the seller canceled the contract because they can get a higher price now. And so we're hearing that across the country, and it's really interesting what's going to happen with this. The supply issues, something's got to break loose.
Yeah, absolutely. It's a huge headwind to the purchase markets right now. Refis obviously ground to a halt with the rise in interest rates, and also a lot of talk in the hallways this morning and afternoon at the Texas MBA around a release that the CFPB put out yesterday. Another one of their very strongly worded press releases where they quote unquote said that they were going to enact their words, largely unused provision of Dodd-Frank to examine non-bank financial institutions to really hold them to the same standards as banks and depositories, those that they feel pose a risk to consumers by engaging in either unfair, a very open term there, deceptive or abusive practices. Do you get a chance to see this news release? And again, as somebody that has owned an IMB for a long time and just bought a bank, fascinated on your perspective on this one.
Well, and I think the other piece to that too, so there's the IMB, there's the bank, and then they're talking about fintechs, right? And so we're looking at partnering with the fintech at the bank level as well. So now we're going to get it from all three angles here. I read that, was taken back quite a bit. And I don't know about you, Rich, but the way I interpreted this, and I felt it was a direct look to payday lending, right? Fintechs, air quotes, really tend to be more of a lead generating source where they can capitalize or capture their target and partner with the bank on the backside to make the loans, kind of ride the charter coattails, if you will. And a lot of these look like paper. The paper that they're actually putting it on is a bank paper, and there's that relationship. It's a regulated entity. We've all seen it. We've seen the Netflix, not We Crashed, but the Netflix on payday lending on the Scott Tucker group, doing the unfair and deceptive practices. I think this is that play. I don't know about you. I mean, it felt like really we're going to go after payday lending and non-bank entities. Are car dealerships involved in this? Is this auto paper, right? And those practices? Or do you think that's more? Is this going to be more directed to those mortgage companies, the IMBs, and treating them the same way as the banks are? What do you see?
Well, payday lenders for sure. I think CFPB, since the beginning of time under Cordray and, not as much during the Trump administration, but now again with this new administration, very quick to make comments about payday lenders. I think that is going to be a clear area of focus for them. On the mortgage side, my general sense, CFPB and mortgage, right? They're not looking to go after the First Mortgage Direct doing $1.6 billion a year in Kansas City, Missouri. But what they are looking at is IMBs now have 72% overall market share.
Right.
They're not regulated by the banking entities that are, as you now know, are all over banks and very, very strenuously regulate them. So I think they're a little uncomfortable with just how much mortgage business is being done by entities that are not regulated in their mind as strongly as banks. And then you've got all these big IMBs, if it's better.com or Rocket, that just continue to make headlines for the wrong reasons. You ball that all up. And I think the CFPB is just kind of looking at it and saying, we're going to enact this provision that gives us the right to go in and examine them as if they are banks. And, maybe through the words, you get action. I know I talked to some owners this morning of IMBs here at the conference, and it got their attention. So
yeah, right.
I mean, if that's their intention, it seems to be working, at least from where I am in Austin, Texas today. So
yeah, it's like, hey, we just did, how many $1 trillion in loans in the last 2 years, and now things are going to slow down. Ooh, let's go see what kind of mistakes were made, right? Let's go figure this out. So yeah, it'll be interesting what comes out of it. Again, dealing with the FDIC and dealing with the states, it's all right. Well, more regulation. Here we go.
You're now right, a seasoned vet. That's my past. Is I remember just running mortgage for banks. I mean, there was always some regulator in. If it was fair lending or safety and soundness or our internal auditors or the OCC we were regulated by when I was there. There was always somebody there. It just becomes part of your process. And but it seems as if that they're trying to get the attention independent mortgage banks. I think because of the market share thing more than anything. And also CFPB has also made many comments about fair lending, unfair practices was one of the terms they used in the press release this morning. They now have all this HMDA data. And that's where if I was an
Yeah,
IMB owner,
right.
even, guy your size, nice, medium-sized company, I'd make sure I was taking a close look at that. What does my HMDA data that I'm submitting to the government say? What does it look like relative to the demographics of the areas I'm lending in and all that jazz.
It's
So
interesting you say that. We've kind of, just because of that, we've stepped up our, instead of looking at fair lending, whether it's on obviously an annual basis, we've moved it up to a quarterly basis just for that very reason. Government's got a ton of data. They can at the click of a button and have a report, they can see, almost identify almost immediately, where did we go wrong? What did we do wrong? So I think it's important for sure that IMBs and banks alike are looking at those fair lending reports, looking at your HMDA reports. Just because you have to file those annually, let's actually dig into it before those things get too far out.
yeah,
Hindsight's
absolutely.
always 2020. Now is the
Yeah.
time to start looking a little bit more forward.
Yeah, good smart leaders like yourself ramping up how frequently you're looking at that and what you're doing with the results of it. Certainly a best practice amongst our smartest members, and to me just smart business right now based on some of the rhetoric and things like the release we saw yesterday. So we will see what happens, and also talk in the hallway here in Austin just about the general climate is really tough right now. A lot of news about layoffs. Wells Fargo, other Rocket Mortgage came out today and said they're announcing buyouts they want to reduce 8% of their total staff. Members at TMC and a lot of the lenders here at TMBA, they're more small to medium-sized lenders, are the types of lenders that are more likely to not lay people off, right? To try to hang on as much as you can and maybe just, don't replace people through attrition. But I'm starting to feel that it's starting to hurt more because the rate impact on volume is carried into, we're almost into May now. And
Oh
the
boy.
supply issue plus the rate as it relates to refinance business issue, it's making things kind of tough right now.
Well, and you look on the forecast, Rich, I don't know about you, you just mentioned 5 different moving parts. What does that have on the impact of the overall economy, right? Obviously, interest rates are going to slow things down. And it's not just to our industry, right? As we're doing mortgage lending, sure, that get rid of refinances, those are out the door. You're very minimal in the cash outs, and so obviously purchase. But long-term interest rates up, buyer supply of homes way down. Why would anybody want to sell their home now, right? So now they all refinanced. We did them all. Values all the way up. Now, okay, so I'm going to trade my house that I have a 15, 20, 30-year mortgage, likely in the 2s, if not the low 3s. So now you're going to tighten it up even more, interest rates even higher. And then you start throwing in massive amounts of unemployment in there. I mean, I don't know the exact statistic of the amount of people that we employ just in the mortgage space. But you look at the last 3 months of layoffs, I'll just use Kansas City, for example. I know of different institutions, myself included, that at least 500 people have been laid off in the industry just in Kansas City. And we're a small market, right? Yes, we have some larger players in the consumer direct space here in Kansas City. We seem to be the hub. But Wells Fargo, if you said 8%, I'm sorry, Quicken, Rocket, if you said 8%, I would venture to guess that's a 25,000, maybe 30,000 staff. You're talking 2,000 or 3,000 people there. Multiply that across the board. I mean, you're looking, and the amount of folks that were laid off at Better, which those videos are just, I mean, that guy's just funny. I won't even go down that road. It's kind of like everything that you want to be as a president, CEO of an organization. Here's what not to do. Just do the opposite. just do the opposite. But that's a compounding number. What is this effect? Do you feel like we're maybe, even though we're in inflation and it's going nuts, do you feel like this recession that it's almost inevitable? Perhaps it's already here? Should we start looking at it that way?
It's
Is it
hard
much
to say.
bigger?
I mean, there's been so much employment movement in America. I mean, right? Like these layoff jobs, these are jobs that weren't even in the mortgage industry when we were rolling along at a $1.6 trillion, $1.7 trillion 2.1 trillion clip, even with the downturn. Most people are still projecting over 2 trillion, some 2.5, 2.6 this year, which would historically be an above
It's
average year.
still
I don't know if we're
crazy.
going to
Yeah.
get there, but I think a lot of those people came into mortgage from, right, like the service industries, like during the pandemic.
Oh boy.
They
Yep.
were hemorrhaging jobs. We were taking anybody that could fog a mirror to process, underwrite, and close. Now the pendulum kind of swung the other way. I don't know about you. Last 10, 15 times I went out to eat, it's like the hotel I'm at here. They're like one of the two restaurants, a million people at this hotel. Like just hour and a half wait for lunch because one of the two restaurants is closed. So I don't know, maybe it swings the other way. The broader economy, man, it's hard to say. There are employment is still strong overall in America. There are some strong wage growth and some spending is still pretty strong, but there's a lot of concerning elements as well. And I think it all just boils down to inflation. There's a lot of people now that feel like inflation may have peaked. Hopefully that is correct because if these next couple of inflation numbers show a higher than expected pace continuing forward, man, it really could wreak havoc with interest rates even further. And then just our economy in general, as people are pretty inflation fatigued at this point.
Uh-huh. Yeah, we were COVID fatigued. Now the new buzz is inflation. That's every conversation I have, whether you're in finance or not. I'm seeing the stickers. I did that with, all politics aside. I'm just seeing stickers all over the place next to the gas pump with president pointing at it, said, I did that. There's so many pieces to this that, it could be a pretty interesting storm in one way or the other. I'm not sure. Throw in one other thing to this, Rich, and pardon me if I'm hijacking this, but if interest rates are going up, buyer and sell supply is going down, and rent is going up, and all these folks that are not being able to buy are going back into renting in this extremely expensive environment, and there's not enough on the rental side. What's the unaffordability rate? Where do we tap out on that?
That's not even talking about looming property tax increases that are going to be coming down the pike. Everybody's homes are valued more. There's limits on how much municipalities can raise the value of a home typically as it relates to property taxes, but that's another piece of it. My hope, the best case scenario is inflation has peaked. We start to see, we're still in a high inflation environment, but that it stops raging and the next couple numbers are, at or below economist expectations. I think that will really cause some relief in the fixed income markets, mortgage bond markets, mortgage rates, get this 5.6, 5.7 back down to something lower. If we can, you try to look at a positive spin on what the hell is going on with mortgage rates right now. If we can get back to 4.5 at some point this spring or summer, which is not out of the realm of possibility, people are going to view that a lot different than they would have viewed 4.5, 4 or 5 months ago.
That's
I
right.
think you make a great point about all these people sitting on homes. Great point. Why would you sell your $500,000 home to buy that $650,000 one you want? If your existing one's at 2.5%, you got to pay up for the new home more anyway, and you got to go from 2.5 to 5.5. But maybe if we get down to 4.5, that will cause some of those step-up buyers to list.
That's right.
It'll make better affordability for those that want to buy. With the increased supply in theory of more homes on the market, because people got to live somewhere. Rents are exploding. Rents are going up.
That's right.
You look inside the numbers on rent increases year over year, it's 20-some%. But the last few months, it's annualizing at 25, 28% year over year. If it continues at this clip, it still makes buying a home a much better deal than renting. Hopefully, that scenario can play out and be a positive ray of light for our industry and housing in America in general.
Yeah, and that's the other piece to that too, is that those that might be coming out of their rents here in Kansas City, one of the things that we have a very limited supply of new homes, and being able to build a starter home. We can't even get $300,000 homes built fast enough, and barely. The most recent one I looked at was a 1,200 square foot split level for $285,000. It was sold before they even poured the foundation. But there again, it was almost difficult for the contractor, the home builder, to build that home. Where else can you put those? I think that's the next wave of things. Where can people go to get that first or maybe second step up home?
Yeah, it's, we had the National Association of Home Builders president at our conference a month ago. He got up on stage and said, folks, if you want my members, the home builders of America, to build affordable homes, I can tell you right now, it is not happening. That is the direct quote. He said the average regulatory costs are $96,000 per home. We have no trade agreement with Canada to get lumber. Supplies are through the roof. We
Yep.
can't cut down our own timber in our forests because there's one squirrel 100 miles away. And it was a very sobering picture of the greatest potential solution to the supply issue, right? Build more homes. We've been talking about needing to build more homes in America for 5 or 6 years. It's just been exasperated and it accentuated these last couple of years with all the supply line issues. So that's the really concerning part to me, is that it doesn't appear like there's, to your point, that $300,000 new home. It's almost not getting built, and what that could mean for housing, short, medium, and long term.
Well, let's put some positivity to this, Rich. It feels like we've been talking about all doom and gloom. Here's the ray of sunshine. Every cloud has its silver lining. I firmly believe that, but for our industry in the mortgage business, this might be the worst that we will ever see, right? It was different in 2007 and 8 when it was all falling apart. We had bad loans, bad underwriting criteria, stated income, stated asset, no income, no asset, adjustable rate mortgages with prepayment penalties longer than their adjustable period. We had a storm. What I think we have here is the positive side of this is we all hopefully practice what we preached with our loan officers. You just came out of the 2 best years you've ever had in your career. We'll likely never see something to that magnitude again. Hope you saved. Invest in your people, because if you make it through this, I think M&A is going to be pretty big for the next year. But you make it through this, you'll know how your business works better than ever before. You're looking at every line item on your general ledger. You're looking at that investment in human capital. I was meeting with my team earlier this morning and yesterday, talking about in 2013, 2016, and 2018, those kind of down years in this cyclical pattern, what our investment went into technology into those times, right? What are the things that we can do to improve and enhance and get better, quicker, faster, more efficient? This time it's, how can we invest in our people to help them and help us get through this? And so you start to uncover all those things, because we come out of this, everything looks like rainbows and butterflies after this. I'm really actually excited. I've switched my gears to, I'm not worrying about what has happened 5 minutes ago and back. I'm looking at this future, and I think it's we're all learning how to do purchases now, and that's, as a consumer direct organization, that's something that we haven't done for 13 years, right? We've talked about it. We've said we're going to need to do it, but the industry is now all purchase driven. And we're going to know how to be able to deliver better customer service. We're going to know how to engage with our realtors and our referral partners. And so the future looks really, really good for everybody. It's just a matter of getting through it.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by First Mortgage Direct and Bison State Bank President and CEO Ryan Weibe. And Ryan, great points there. And, leaders like yourself, you've been through these cycles before, right? We had one of these in 18, 19, had one in 13. And you're right? It's back to basics. It is back to, after 2 years of just printing money on refis, understanding your business, getting into the line items. And unlike 07 and 08, many things going for our industry and housing in America in general. Credit quality is incredible. There's almost no delinquencies. Homeowners are sitting on just truckloads of equity in their homes. So you have that protection on the asset and value side. A lot of strengths, core strengths to the U.S. economy, employment and wage growth, and consumer spending still strong through a lot of headwinds. And most importantly, there is incredible demand to buy houses in America. it is being muted right now. We talked at the beginning about the pipelines of pre-approved borrowers dying to buy houses, right? But we got to figure out the supply issue. I think there are fixes to it, but it's going to require, and I am not a big government guy, but it is going to require government intervention. We've talked about a number of different things that could be done almost immediately, tax breaks or to home builders to incent them to build lower priced homes. With the people that own investment properties, incent them through capital gains tax waivers to sell
Yeah,
their
to
house,
unload those.
to
Absolutely. I
unload
didn't
them.
think about that. That's
It's going to be
terrific.
all lower priced homes. So my problem is that, like typically with government, they don't act until it's too late, and then they don't properly apply the right solutions. And that's my only fear. I think there's things that could be done. I'm shocked that they're not being talked about more. But to the broader point, there are a lot of strengths right now to housing, to the economy. We just really got the rate issue. It will play itself out. Again, I don't. Rates historically are not incredibly high, and it's still a much better deal than renting. We got to figure out this supply issue, and to me, that is the story of 2022 and 2023. What happens with that? Because there's not a lot of easy or immediate relief on the horizon.
Yeah, you nailed it. I can't offer any more interjection to that, Rich. That was spot on. It's and once the smart people figure it out, I'm sure they'll let us know, because I'm just going to sit behind my desk and wait for them to figure it out.
Exactly. I'll try to get them on the show, hopefully, and they can tell us all. So
That's right. That's right.
Just a couple minutes left, Ryan. I would imagine the Kansas City housing market, you've alluded to it a couple of times, is popping hot. I mean, it's always been a hot housing market, but it's got to be bonkers there right now.
It is still very much bonkers. And in fact, I'm personally living through it myself. I decided, I think it's time for us to act like sellers and buyers. And so my wife and I decided to put the house on the market last week, thinking, oh boy, okay, let's see, maybe we can get it sold in a month. No, it took 4 days in a bidding war, just like everything else. And it just kept going up and going up and going up. And then here comes the appraisal waivers. Here comes the inspection waivers. Here comes all these things. Like, this is when you sit on this side of the table, when you're the one that's guiding and informing and doing these loans and going through these process all the time, it's just second nature to us. When we flip that seat and we turn into the consumer, we like turn into the other side, you start to scramble. But it's still very hot. It is incredibly hot. There's the demand is, like you said, it's nonstop. Supply is super limited. I think we've got less than 1 month supply. There were no homes in my price point in 2 zip codes in my surrounding 3-mile area. None. I was the only home on the market. And it went just like that. So case in point, living proof, going through it myself. It's still kind of fun, quite frankly. So now Casey's always been that market that nice steady ups, no real downs, no big bubbles. And here we are, 22% appreciation year over year. I think I did the math on mine. We went up 30, my price point changes a little bit, but 35% in the last 5 years. It's nuts.
Unbelievable. It's crazy. I mean, we could be in a position at the end of 2022, if what I suspect is right, where we will have had on average about 50% appreciation of homes nationally over the last 3 years.
Oh boy.
Essentially since the beginning of the pandemic. And I don't know what that means, other than historically what follows that is typically a roller coaster. So
that's the one I don't think we're going to have. I think if anything, we're just going to flatten, and I'm hoping and praying for that. I think a flattening wouldn't be a bad thing.
Yep.
And a little slowdown to let some more of the entrants come in. I think that might be part of that master plan. So
excellent. Well, Ryan, always appreciate and enjoy talking about the industry with you, brother. You're going to always get the repeat invites to come back and co-host with me. And
you got it.
Congrats on the pending merger with Bison State and First Mortgage Direct and the sale of your home. And looking forward to tipping back a cold one with you sometime soon.
I can't wait, man. Thanks for having me on. I appreciate it.
Absolutely. To our audience, thanks as always for spending 30 minutes with us each week. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. You can also find us on our YouTube page and where most of you listen on podcast, TMC Connect on Apple, Spotify, or any of the other podcast platforms. Until next Tuesday, have a great rest of the week, everyone. Take care. Take it easy,
See ya.
Ryan.